So for cost of debt, we're going to calculate the effective interest rate of the company. So again, let's build the frame first before calculation. We're going to make a separate column for a separate section for data inputs. And let's start from cost of debt. So great. We need the effective tax rate as well as the marginal tax rate of the company. Let's start from the easy part, the marginal tax rate. We saw it in this spreadsheet over here. We have our corporate tax rates already ready to go. We need since it's a US based company, we need the tax rates for the United States. So it's way down here, 25%. So we're going to link it rather than just hard coding it. I think linking it is a much better idea. United States corporate tax rate of 25%. And for, this is effective interest rate. And for the effective interest rate, let's build a separate spreadsheet to calculate effective interest rate. So add another sheet. Let's name this cost of debt. So what kind of data points can we utilize? What kind of data do we have in order to calculate effective interest rate? If we have, quarterly data, it might be even better. But since we have annual data for the past 20 years or so, we have data on interest expense. So we can always use this data. Let's just highlight these beforehand in any color you prefer. And then let's move on to the balance sheet. We need data for total debt. So maybe under liabilities, we have data on debt. So things like current portion of long-term debt, current portion of leases. We also have long-term debt and long-term leases. Maybe these four combined are most relevant in terms of calculating effective tax rate. But Koifin also provides us with total debt. So already have calculated total debt for our convenience. So we can use this number for simplicity. And now just simply, linking the data to our cost of debt spreadsheet. We have the total debt at year end. And we also have data on interest expense. And now we can simply link the relevant data to our spreadsheet. So total debt from the balance sheet, we've already highlighted it. So from Let's check the years just in case. From 2004. And for interest expense as well. Let's actually add a little minus sign on the front. And get positive numbers. Of course, we can always simply divide interest expense to total debt, but since, as always, if you want to compare balance sheet items to income statement items, we always want to do an average of the balance sheet items for comparison. So we're going to do an average of total debt, as we did in many practices in Financial Modeling 101. We're going to do an average, calculate average, because these are year-end terms. We cannot calculate average for 2003. We can start from 2005 average. So year-end of 2004 and year-end of 2005. These two averaged. Let's again calculate to the right. And then the effective interest rate would be dividing interest expense to average total debt. Okay. So all seems great. It seems that the effective interest rates are slowly declining for the company itself, despite the fact that during recent years interest rates have been generally going up. But effective interest rates of the company seems to be slowly declining, which is a good thing for company valuations. So now the key question is, are we going to use the current interest rate, the most recent interest rate, or are we going to do some kind of average of the historical years? In conclusion, I think that it's best to do a 5-year average, because we're going to do 5-year averages for other components as well. And we also did, as I mentioned in Financial Modeling 101, many of our analysis, historical analysis, has been 5-year averages. So we are going to calculate other average numbers just for comparison reasons, but we're going to use a 5-year average in conclusion. And let's see, let's simply calculate the data on the right. So 3-year average, the recent 3-year average, recent 5-year average, and recent 10-year average. So surprisingly, whether you do a 5-year average, 3-year average, or 10-year average, of course, if you add decimal points, it could change, slightly, but surprisingly, there's not a very big difference on, whichever average you use. So yeah, that makes us much more comfortable in using this specific data set. And now all we have to do is we want to link it to our weighted average cost of capital spreadsheet. So let's just highlight this, just in any color you want. We're not going to put in so much time in formatting this spreadsheet. Effective interest rate, we're going to cost of debt and link our 5-year average effective interest rate. All right, so now we can, we have these two components ready to go. The pre-tax cost of debt would be the effective tax rate, the effective interest rate of the company, which is 3.7%. The 1 minus tax rate would be 1 minus the marginal tax rate. So that's going to be our part on cost of debt. Let's proceed to equity risk premium, our next part in our WACC calculation.